Hello, this is Blaine McCormick from the Hankamer School of Business at Baylor University with another video in the series on mastering the decision sheets and foundation. This time it's the finance decision sheet, and we want to teach you how to be a financial ninja. So let's get going and see what we can learn. Here's the finance decision sheet, kind of an overview. This is what you'll see whenever you log on there, and you've got green boxes here that allow you to make decisions, and then yellow boxes here that are calculated or locked. They show you the consequences or outcomes of your decisions. And then you've got a chart up here we'll explain a little bit later, but that's kind of a quick overview of the decision sheet. CFOs do two things in there, and if you're going to be a financial ninja, you've got to do two things really well in foundation. You do other things, but you have to one, you have to handle capital expenditures, and we'll talk about what capital expenditures are. And then two, you're going to have to handle the cash management for the firm. And CFOs do this all the time, and it's a learnable skill. So let's see what we can learn in our decision sheets. That graph I want to point to real quickly as well. That's your financial structure, and this is kind of where it was in the opening when we first inherited it. Lots of retained earnings, a little bit of long-term debt. No current debt whatsoever. And I just made some decisions to change that, and you can find those reflected on the balance sheet. But you can see a company now that has a great deal more debt and a great deal less as a percentage standpoint of owner's equity in there. And so you'll just, that's called financial structure, whether you finance with debt or equity. And you'll see that reflected in this chart here. And as you make decisions, you'll see the different slices of the pie move around, and that's kind of understanding and managing your financial structure. That's why that chart is on that page there. Let's start with capital expenditures, or what people call CapEx, which is plant and equipment spending. Or for foundation, it really means how much capacity and automation can you buy each round, which is a great question to have in there, and that depends upon how much equity you have out and how much equity you can raise and how much debt you have out and how much debt that you can raise. And it tells you, it's very handy, foundation is that way. Let's start with equity. If you want to pay for plant and equipment, you can pay with your own cash, which you might have enough to do, or you might want to float some new stock. And the maximum stock issue you can float, if you want to pay for that with equity, is 4,452,000. Well, how did we figure that out? Well, it's 20% of your shares outstanding. You can, float 20% more shares, and so you can see here that we have 2 million shares outstanding, and so 20% of that would be 400,000. If we multiply that by our stock price here, you'll see that the maximum amount of money we can raise for equity this round would be for about $4.5 million in there, and that's how that works. If we want to, we can also raise debt. Get some debt to help pay for the things that we're going to buy. And our maximum issue this year is $2,480,000. You can also see that we've got some bonds outstanding here. Those will have some consequences there later on. But how do they calculate this? Well, you can get debt funding up to 80% of your current of your fixed assets here. So I looked on the balance sheet of this company. They had $9.6 million in fixed assets, and so 80% of that would be $7,680,000. And we have three bonds out already, an $867,000 bond and a $2.6 million bond. So we subtract those out, so that's 80% of fixed assets less the bonds that we already have out equals, voila, same number, $2,480,000. So that's the most that we can issue. Now, as our fixed assets grow and as we pay off bonds, you can raise more capital through debt. But that's how you get that calculation there. And so on your production page, this up here is from the production decision sheet. You'll have a very helpful column that tells you how much, what your maximum capital expenditure, your maximum investment amount, which is just shy of $7 million. And I made decisions here. I bought some capacity and raised my automation that cost $6.5 million. That's the most I can raise on the financial markets there. And so my CapEx budget is that, $4.5 million in equity and $2.5 million in debt, which is just shy of $7 million. That's the most I can raise on the financial markets. If I have some cash, I can throw that in and pay for it as well. But the money has to, if you buy things, the money has to be there. Otherwise, you're going to run out of cash. And so that's how you manage your capital expenditure budget. And let's start managing our cash budget next. The cash management is really key. Here you can see very important fixed cells. Here, your cash positions at the end of each year. You start with $5.6 million in cash there. And we've made decisions that suggest, just predict, it's a prediction only, that we'll have $9.8 million in our cash balance at the end of the year. How did we get that? Well, we have some cash coming in. For example, if we issue $2 million in stock, that's cash coming in, and we add that on top. If we borrow $8.9 million in current debt, that's cash coming in. Or if we sell plant and equipment, that's cash coming in. So that's, we sell something, we get the cash from it. That's real cash coming in. But we also have cash going out. If we buy back stock and retire stock, that's cash going out of our account that buys that stock. If we give a dividend, which we're not here, that's real cash leaving our organization. Or we did buy $6.5 million in plant and equipment. That's real cash going out. And so if we have a starting balance and we look at the cash coming in and the cash going out, we can figure out what our closing cash balance is, and that's really the cash flow statement. The financial sheet does a pretty good job of helping us understand that, but if you want to go to your pro forma cash flow statement, that's even better. And I've got another video out that will help you through the cash flow statement and understanding it line by line, but it's very easy. Basically, are you bringing in cash from your operations? We made $5.4 million in cash from our operations. We spent $6.5 million in capital expenditures, and so we're kind of, we spent more than we brought in. That's kind of a problem there. Now, we had some cash in the bank, so that helps. We started with $5.6 million in cash, but you can see right here, this is your finance decision sheet right here. Are you going to pay a dividend? Did you sell some stock to bring in money? Did you purchase stock and have cash leaving? Did you raise some debt to bring in cash? Did you take current debt to bring in cash? Did you retire debt to have cash leave? We look at that. That's what CFOs do. They look at how much you're bringing in, how much you're spending, and do I need to go raise some on the open market to give us a cushion there? Pretty simple in there, and you learn that through the cash flow statement. Let's close by looking at the balance scorecard. For financials. If you improve your stock price round around, you get your points there. If you improve your bottom line round around, you get your points there. And if you manage your financial structure appropriately, have the right balance of equity and debt. You can't pay for everything in equity or pay for everything in debt. Foundation likes you to have a good mix on your financial structure. You'll get all your points there. The recap scorecard is very important on the financial front as well, so I think I'll just wave at it. It's you have your round around scores, then your recap score, which is kind of cumulative across all the rounds. But if you it tracks your market cap, which is if you're creating value through your financial decisions and your managerial decisions, you improve your market cap round around. It encourages top line growth here, bottom line growth here, top line growth here on the recap. And then really your cash management hits you here. This is a huge point here, 20 points on your recap that you can lose if you're running out of cash too often. So as you learn how to manage your cash, you shore up those points there and do well as you learn how to manage your finances and really run a good enterprise. You get the rest of those points on the balance scorecard. So those are your finance decisions. Let me just wave at two small boxes that I haven't said anything about yet. That's your accounts receivable lag and your accounts payable lag. Your AR lag is also on your marketing sheet, and you can have no days of credit to 90 days of credit. If you have no credit, let's say you move that to 0, it's going to improve your cash flow, but all your customers will have to pay cash rather than taking a small loan from you and paying it 30, 60, 90 days later. And so it's going to reduce demand for your products. Cash only, on delivery is okay for you, but your customers aren't going to like it, so it'll hurt demand. Likewise, you can change your accounts payable lag on your production sheet or here, and paying later does improve your cash flows, but it reduces the reliability of your production scheduling because your suppliers can withhold materials and things like that, so it hurts you there. So I usually advise first-time players to keep those at 30 and 30, but if you want to experiment with those, look at your foundation team guide and learn how to move those appropriately. I wouldn't swing them to the 90s, but you can experiment with those in the low 40s or mid 40s or something like that. So hopefully that's a good overview of the decisions and the finance sheet, and it helps you master those and become a financial ninja. Good luck with that.